Hi traders, we're looking at the week that will be. Now I'm saying this on Friday before the start of the US trading session, so we still need to encompass that situation, but I think it's a good idea to look ahead at the week that will be, look at the event risks, the landmines that we need to navigate our portfolios through, and look at it from a sort of a multifaceted perspective when we're looking at that risk reward. We're looking at interest rate expectations, we're looking at positioning, we're looking at implied volatility and other factors as well as technicals, and trying to make an assessment whether we want to be looking at holding those exposures over these various event risks. Now, in terms of interest rate expectations, we can look at swaps markets, interest rate futures, for example, and we can see at the moment that the next Fed meeting on the 20th of September, we can see 1 or 2 basis points being priced in for that September FOMC meeting. So very little expected there. The Fed firmly expected to sit on their hands. You'd be very surprised if they raise rates. This is one where they're going to look to keep their powder dry for now. And if we look at the November pricing, we can see 11 basis points of cumulative pricing being priced there. So the data this week in the US, certainly the CPI number will go into that pricing for November, and that's the one we're going to be watching. For Australia, we've got the next RBA meeting on the 3rd of October. Again, very little being priced for that meeting. This is one, again, where the market's firmly expecting them to sit on their hands. We've got about 11 basis points of tights being priced into terminal pricing there. In Europe, where we get the ECB meeting this week, as I talked about in a second, we've got 9 basis points of tights being priced in for the meeting next week. It's a 35% chance of a hike. And we've got terminal being priced at 380 out to December, which is about 17 basis points of cumulative pricing into that situation. In the UK, after we've seen conversations from Governor Bailey, from Hugh Pill, and also from the decision maker panel, we've seen a situation where interest rate expectations for the next meeting on the 21st have been brought down a little bit to about 82% chance of a hike, to 21 basis points effectively being priced in there. And we can see cumulatively to the peak pricing about 41 basis points. So I still think that's a little bit rich. I still think they're one and done, and that table mountain approach very much in play for the Bank of England. In SOFR rates in the US, we've got about 113 basis points of cuts being priced in for next year, and that's something that can continue to move the US dollar. In terms of FX pricing, you have seen this week the US dollar making a really strong ascent against all currencies, certainly against the Mexican peso, against the South African rand, against the Korean won. Good flows against the Australian dollar, which is down about 1.2% against the US dollar this week. But that dollar index in a very, very sharp ascent. We've gained about 5.7% from those recent lows, and we're looking at those March highs very much in earnest in this momentum move we've been seeing. Certainly, I continue to like sterling cable to the downside. I think that 200-day moving average comes into play. And dollar yen, whilst obviously it's got risks with intervention rhetoric still very much rife from various officials, I want to be trading as a momentum move through 148 for further highs playing through. Now, in terms of volatility, of course, we've got the VIX trading at 14.4%, so still pretty low in terms of implied volatility for the S&P over the next 30 days. The MOVE Index, which looks at Treasury volatility, which I think is really, really important, for just cross-asset volatility more broadly, currently sitting at 105 on the MOVE Index, and that's near 12-month lows as well. So for broad equity and cross-asset volatility move up, I think you need to see that MOVE Index moving sharply higher. And on the FX volatility side, you can see the JP Morgan G10 FX vol index at 8.38%. Personally speaking, like a bit more movement in FX markets. I'd like to see that above 9% coming through. And in G10 FX vols, looking at 1 week vols, which encapsulate the data which we're about to talk about, you can see really it's only euro dollar which is showing any kind of life. We're currently sitting just above 8%, but that's about the 24th percentile of the 12-month range. Everything else we're seeing is really below that sort of 15 percentile. So people, I know that realise volatility has been coming in pretty low, but people aren't expecting big movements to play through. Now, what are we watching for the week ahead? The ECB meeting, which comes out on Thursday at 10:15 Eastern Standard Time, I think is going to be a really interesting meeting. The question you've got to ask yourself is, do you want to hold those euro exposures over that meeting? Now, the market, as I say, is pricing 9 basis points of tights. Obviously, if we get that 25 basis point hike, then you're going to see a much more pronounced move to the upside in the euro than if what you'd get if they leave rates on hold and we see some downside, given that that's that skew of 9 basis points there. My gut instinct suggests that there probably is enough for them to sit on their hands at the moment, given what we've seen from the data dependency side of things, and some of the ECB officials like Schnabel have come to a more balanced situation there. But I think as well as that, not just whether we get a rate hike or not, we're hear a more detailed discussion about PEP reinvestments. We're going to get new inflation and growth projections coming from the ECB. So that could be a really big one to watch going forward as well. On the US side, we talked about the idea that the market is toying with with the idea, do we get a rate hike in November or not? Well, that CPI number that comes out on Wednesday is going to be a really big one indeed. Now, the market's expecting headline inflation month on month to be up 50 basis points due to base effects and energy prices playing through, and on the core number up 20 basis points month on month. Now, that's going to take the year-on-year run rate to 3.6% potentially, and that's up about 40 basis points from the prior read. And also on the core read, actually, which is going to fall, expected to be at 4.3% from 4.7%. Now, if we look at sort of expectations in the market, you can look at swaps pricing. People can actually bet on where that inflation is going to come out. And on the headline number for a year-on-year clip, expected to be at 3.6%. The Cleveland Fed numbers, if you look at their nowcast models, are anticipating higher numbers, so the inflation numbers to come out higher than the street's forecast, with 4.46% expected on core and 3.8% on headline. Now, we'll say the form guys does suggest favour selling dollars around this point. I'm not saying that's going to be the case this time round, but you can see in the 30 minutes past the last 6 CPI numbers, we can see the US dollar index has fallen in that 30-minute period. Now, of course, we keep an eye firmly on China. On Friday, we're going to be getting fixed asset investment, industrial production numbers, retail sales numbers, and a decision whether they look to cut the medium lending facility, something they obviously did last time around, but the market's not expecting them to cut that rate from 2.5% this time around going forward. Now, we are expecting a little bit of improvement in the data flow to start coming through, but it's really not until we get to the September series where some of these stimulatory measures are really going to feed through into the real economy. But of course, we're watching China and dollar CNH very, very closely indeed. In Australia, we talked about the market being very much data dependent. On Thursday, we got Aussie jobs, where the market's expecting 25,000 jobs to come through. The unemployment rate expected to be at 3.6%. Again, we continue to watch that participation rate very much in earnest as well. But I think once we get past this point, Aussie dollar just really continues to be a proxy of what's happening in China as well. In the UK, as the market really tries to make up a firm decision as to whether we're going to get this 25 basis point hike at the next meeting, we're going to be getting UK jobs and also wage data. So I think that's going to be a really big one there as well. We get industrial production and manufacturing numbers. I expect very small massages of the pound on the back of that. And then we get conversations coming through, speeches from Hugh Pill and also from Catherine Mann as well. So I think that could really dictate that 25 basis point argument, and also what happens with peak pricing. But the pound certainly looking pretty heavy in this situation playing through. We get Canadian jobs, and on the stock side, we're going to keep an eye firmly on Apple. We've been seeing that stock making a firm descent given the headlines we're seeing around China curbs and iPhones. But we do get the Wonderlust event where Apple will be showcasing its new product range, obviously specifically the iPhone 15 and other factors playing through. But will that please the market? Usually these aren't particularly volatility events, but something, given that we are seeing a very heavy tone in Apple and obviously it's waiting on the market, we are watching very closely indeed. Now, the market is running a pretty punchy long US dollars if you look at real money and also leverage community. Retail traders now are trying to fade this move and aggressively shorting US dollars here, looking to buy gold and various factors as well. So a big week there, obviously watching that ECB meeting, watching that CPI print. We're in earnest. Trade with Pepperstone.